This video provides an independent technical analysis and reflects my personal market views. It is not financial advice. The July 28th session concluded with a stark fracture across the major indices. Rather than moving in tandem, the market split into two distinct regimes. We are observing inter-market divergence. This occurs when historical correlations break down and assets that usually move together begin splitting apart. During this session, the Nasdaq entered a steep downtrend. Meanwhile, the S&P 500 and the Dow Jones showed significant relative strength, holding their levels despite the volatility in tech. Broad market panics typically see all sectors sell off in unison. This specific bifurcation suggests we are not looking at a systemic collapse. Instead, the data points to targeted de-risking. High-exposure assets are being liquidated, while capital is simultaneously reallocated into more stable areas of the market. This sudden shift in behavior is tied to the heavy macroeconomic calendar scheduled for the end of the week. Understanding the mechanics of this divergence provides a clear framework for navigating the low-conviction environment expected for the July 29th session. To see the extent of this decoupling, we have to examine the one-hour price action and the underlying support structures for each index. On the one-hour chart for the Nasdaq, sellers remained in total control through the close. The trend here is intact. There is a clear sequence of lower peaks and lower troughs, indicating high momentum selling with no signs of reversal. When we compare that to the S&P 500, we see a much slower decline. The aggressive verticality found in the Nasdaq is absent here. The S&P is respecting horizontal support levels. Buyers are maintaining a structural floor that hasn't broken. The Dow Jones shows even more resilience. By the end of the day, price action shifted from a decline into recovery and consolidation. While tech broke recent lows, the Dow support zones remain firm. The volume profiles confirm this. The heavy selling in the Nasdaq was backed by significant volume, but we did not see a corresponding surge of sell volume in the S&P or the Dow. This volume deceleration suggests the selling pressure is concentrated and has not triggered a broader exit from the market. These technical differences indicate that the current sell-off is isolated to specific sectors, with the broader market maintaining its support levels. To find the source of the Nasdaq's weakness, we have to look past the indices and into the internal market breadth. This heat map visualizes where capital is moving. The Nasdaq's collapse is driven entirely by the semiconductor sector, showing deep red across the board. Losses are significant. AMD fell 8%, Intel dropped 6%, and Micron finished down 9%. Due to their heavy weighting, these specific names act as a drag on the entire technology index. However, the data shows this capital isn't leaving the market entirely. We are seeing an active rotation. As money exits high-growth tech, it is flowing into defensive and financial sectors. Safe havens like Berkshire Hathaway and United Health saw gains of 2 to 3%. This is sector rotation in action, the movement of capital from high-beta industries into value-oriented sectors to manage risk. Large institutions are shifting their exposure away from growth volatility and into defensive positions. The heat map indicates that while tech is under pressure, capital is staying within the market, looking for safety and defensive sectors to wait out the upcoming catalysts. This flight to safety is a response to these specific economic events scheduled for later this week. This calendar shows why the market is acting with urgency. Volatility is tied to high-impact releases scheduled for Thursday. Morning features the federal funds rate decision, FOMC statement, and press conference. Later, advanced GDP data adds another layer of potential movement. These are binary events, where the outcome can lead to immediate and extreme shifts in price. Institutional desks often choose to reduce their exposure to high-beta technology when facing data drops of this magnitude. Tuesday's close aligns with a mechanical de-risking cycle. The market is positioning itself for Thursday's macro impact. Using these technical and internal indicators, we can establish a baseline for the July 29th session. July 29th will likely act as a transitional day, sitting between the recent rotation and the upcoming FOMC data. In the Nasdaq, we should expect early rallies to be rejected by established structural resistance. It is important not to confuse a temporary bounce in tech for a long-term change in trend. The broader market, The S&P 500 and the Dow will likely experience choppy, range-bound consolidation as participants wait for more information. Without the Thursday FOMC data, institutions lack the clarity required to initiate large directional positions. For July 29th, the focus is on patience. The market is waiting for Thursday's data to define the next major macro trend. As always, manage your risk according to your own plan.